Hey everyone, it's Mark Ferguson with Invest for More, and I'm back with another real estate video. Today we're taking a look at the monthly housing statistics. We're taking a look at inflation, we're taking a look at new builds, interest rates, and we're going to try and make some sense of what is happening in the housing market. So every month I like to look at the Realtor.com housing market report, which tells us active listings, prices, days on market, all kinds of great statistics. And then they just came out with inflation data today, which we'll talk about as well, and how that might impact interest rates and mortgage rates. We'll show you what mortgage rates are today and show you different sites and how different they can be. So make sure you're looking at the right mortgage rates. And then we'll look at supply and demand and how that probably isn't going to cause a housing crash anytime soon. All right, love the likes, love the comments, love the shares. I am a real estate investor. I've been a broker for 20 years. My channel is mostly showing my own investments. And yes, in this market, I am still buying properties. I have a flip under contract to buy for, well, I shouldn't tell you how much it is yet. I'll tell you when I buy it. It's listed for $450,000. I've got another flip I'm buying for $310,000. And I've also got a laundromat, car wash, apartment, and a little shop under contract to buy as well, all in the next couple of weeks here. So good time to subscribe to my channel if you've never been here before, as we have lots of exciting stuff going on. All right, so first off, every month Realtor.com comes out with some housing market stats and trends that are really, really good. And it shows you what's happening as far as days on market, active listings, all kinds of great data. Before we do that, I want to go over something really simple just to show you a little bit of supply and demand, though, because a lot of people assume that with higher interest rates, housing prices had to go down. A lot of people just assume that because demand will go down. Well, supply and demand often determines what prices will be. And if demand goes down, it can cause prices to decrease, but not always. Now you have to look at supply and demand, not just demand, because supply is important there too. And if there's an imbalance in supply and demand, if demand goes down, it might not change pricing at all. So I put together this sheet right here that just shows houses and buyers. This is houses for sale and people who are willing and able to buy at that moment. And I just want to give a short example of how supply and demand can be changed and still not cause prices to go down. So in the US right now, there's about 1 million houses for sale. FYI, in 2006, before the last crash, there were 6 million houses for sale. 6 times how many houses were for sale then as there are now. But at 3% interest rates, which we had beginning of 2022, 2021, maybe there were 5 million buyers. And this is just random numbers. They're not exact for buyers, but I just want to make a point here with that. So there was a definite undersupply of houses, way more buyers than houses for sale. That pushed prices up. We had bidding wars. It was crazy. Well, if rates go to 5%, which they did, they increased, you might still have 1 million houses for sale, but now you have 3 million buyers because 2 million can no longer qualify for a home, or they don't want that 5% rate. Who knows what happens? But as you see, there's still plenty of buyers for the houses that are for sale. There's no reason this would cause prices to drop or crash. Maybe prices don't go up as fast. They level out, which we've seen, or they keep going up but not as fast. But there's still way more buyers than there are houses for sale. So just because demand goes down doesn't mean prices will go down. That just does not happen in the real world. There's too many other factors to look at. Now, what if rates go to 7%, which they're really close to right now? At the end of 2022, they were close to that. Well, maybe there's 750,000 homes for sale now, because at 7%, more people decide not to sell. They don't want to give up their 2 or 3% rate they had before. Inventory drops. So not only does demand drop, because maybe now only 1.5 million people can buy, but supply drops too. So there's still plenty of people who can buy houses, especially because there's fewer houses for sale. Again, prices don't drop. They're not going to decrease with this scenario. Now, these aren't exact numbers. Of course, if something crazy happens, if building suddenly increases or a ton of properties come on the market, or if demand gets cut way, way, way down, then you could have more supply than demand. Maybe you see prices decrease in that scenario. But I just want to make the point, just because demand goes down doesn't mean prices will go down. And then I have this little star right here at 7% interest rate, even at 6, at 5, they build way fewer houses, which means supply goes down even more. And in the future, we will see an even bigger discrepancy, because if they start building fewer houses now, a year, 2 years down the road, that's when we'll really feel it. Inventory will be even lower. So even though they say they want to raise rates to slow down the housing market and appreciation, what they're actually doing is setting us up for even more problems in the future, because building will decrease, there'll be less supply, and if rates do go down, which I think they might based on inflation numbers, then you can see another massive boom, another huge imbalance of way too much supply, demand, way too little supply. High rates are not helping anything. If rates were lower, they could build more, and then maybe we might have more things in balance. So let me show you what I mean with building real quick. Here is the St. Louis Fed economic data. This is new privately owned housing units started, single family units. So a lot of times people say there's record amounts of houses under construction right now or being built. That is true. There's a record number of housing units being built that are under construction. That means all units, apartments and single family homes. And under construction means they're being built right now. And there's a record number of that because it takes 1 to 2 years to build now, where it used to take 6 months. So there's not a record number of houses being started or a record number of houses being completed. There's just a whole lot under construction because it's really hard to build and takes a really long time. But this shows us single family homes, which I think is important, and starts, which means houses we'll be seeing built in the future. And as you can see here in 2005, we had a record number, 1.8 million starts. But even back before that, we were right around 1 million to 1.2 million was average. Well, after the last crash, huge deficit in houses being built for many years. And we just barely got back up to average here the last couple of years. And we were maybe slightly above average, but right about average for a couple of years. And then rates shot up. Boom, building decreased again to below average numbers while we have a shortage of housing. This is why rates being as high as they are is going to make housing less affordable in the future, because there aren't enough houses and rates discourage building. So with higher rates, who knows when, we could definitely see house prices increase significantly because there's less building now, and eventually rates are probably going to come back down, which could make things out of whack. So now let's look at what the actual data shows happened last month. All right, so this is the May 2023 monthly housing market report from Realtor.com. Tons of good information in here. Just some key points. The number of homes actively for sale increased by 21.5% compared to last year. Last year was record low number of homes. So it's also really important to look at not just year over year, because 2022 was an anomaly. It was record low numbers of houses for sale, record high appreciation, record low days on market. And what's really cool about this report is it goes back 5 years. So we can see the years before COVID, before last year, because last year was not a normal year. With this report, we can see what normal stuff looks like. All right, home sellers were less active with 22.7% fewer newly listed homes. Like we said, fewer homes are being listed because the rates are high. The median price of homes for sale increased by 0.9%. Prices are still going up. Yes, that is true in many places. Zillow, Realtor.com, there was another one, have changed their estimates. They think house prices will increase in 2023 now. Not a lot, not a ton, but most sites do now anticipate house prices increasing this year. All right, now we can see the cool charts. These are active listings. So the blue is the different years, 2017, 2018, 2019, 2020, 2021, 2022, and 2023. So right here, if you can see this May of 2023, that's where we are right now. And you follow this pink line back, and this shows us how many houses are for sale. And then it goes back to 2022. It becomes yellow. So if you kind of follow it back to here, and you can see it goes down to here to 2022, where there were record amounts of houses for sale, like record low, I should say. And that did increase. When rates went up, we saw an increase. And then we saw a decrease in the fall, decrease. And what's interesting is these other years, 17, 18, 19, all saw increases in houses for sale in the spring. then decreases in the fall. We've been seeing a decrease in houses for sale in the spring, except for this last month, we had just a little bit of an increase, which is the opposite of what normally happens. So there's been fewer houses listed, which means not as many houses for sale. Total listing count, again, if we go to the pink, which is 2023, we see it right here. Total houses for sale, the same as last year, which was record lows. You can see this is the lowest number of houses for sale of any year, and half, maybe a little bit more than half of the years before the pandemic, when what we would call them probably normal years, prices were still going up. It wasn't like that was a crash or anything. A crash would be like up here somewhere for how many houses are for sale. So it's really hard to have prices go down or have a crash when there's a record low amount of houses for sale. Pending listing count. This is how many houses are active or pending for sale. That means they're kind of under contract to sell. They should sell soon. That is very low as well. That usually is very low. When this is very low, because the fewer homes there are for sale, the fewer there are under contract to sell. So that's not surprising. But it is increasing just like it has most every year, following the trends. Newly listed homes. This is an important one too, because this is how many homes are coming on the market. And you can see record low this entire year, except for April of 2020, which was COVID, right? Everyone took their house off the market. Nobody's listing their house because you couldn't even show houses. Except for that, record low amounts of houses coming on the market. And it's like the rate of increase is even like lower than every other year, except for that one 2020 month. And that's what happens with high rates. You just have fewer and fewer and fewer listings. So demand might drop some, but supply is dropping right with it. We keep scrolling down and we can see days on market, which is a very good indicator of what the market is doing. May 2023, 43 days. So it is higher than 2021 and 2022, which was a record, but it is also lower than those other years before the pandemic and before 2020. 2020 was just a weird time of year. This time of year, so we just kind of throw out all of those stats because of COVID, just wrecked everything. But you can see it's right in the middle. So it's not like it's taking that long to sell houses at all. No, we're not at record lows like we were in 2022, but still a very healthy real estate market for sellers. Median listing price, highest it's ever been. Even with 2022 having this massive increase, we're still higher. Not by much, but you can see this price is increasing. So what did we see in the previous years? 2021 went up, flattened out, went down a little bit in the fall. That's what almost every other year did, right? The same trend. 2022, which is yellow here, did the same thing, but much more so. We had a much higher increase, and then we had a higher decrease than normal, but still ended up higher than the start of the year and much higher year over year. And then, just like every other year, come the new year, prices started to go back up again. They have continued to go up. Not as fast as 2022, maybe not even as fast as 2021, but they're still going up. And we're returning to kind of this curve we saw down here in these markets. So wouldn't it be surprising to see prices, slowly go up, maybe even level out now, and maybe even slightly decrease at the end of the year, because that's what they do every year. Now, if something crazy happens, like interest rates drop significantly, that could change and we could see a difference, because there's so many buyers out there waiting to buy, waiting for lower rates. If they do drop lower, we could see a boom again, and there just aren't enough houses out there for all those people. What we really need, if you want a more imbalanced market, is more building. I know I've said it 100 times, but higher rates discourage building, lower rates encourage it. So if they do lower rates, we could see a buyer boom. We could see building increase significantly, which is good, but it's going to take a year or two for those houses to come on the market, because that's how long it takes to build now. All right, scrolling down here, price reduced share. That was a big talking point, right? Everyone was talking about, there's a record amount of price reduced, the market's crashing, it's all coming down. In 2022, we can see, started here, this yellow, and it had record low amounts of price reductions, and then it did increase significantly, right? It bucked all the trends, a huge increase of price reductions, but it just got back to normal. It just went in between 2018, 2017, just a little bit higher than 2019. Nothing crazy. It just went back to normal. And then, boom, they dropped just like every other year did. And now here we're pink again. But look at this. The number of price reduced decreased more than every other year and has been decreasing. And we're right back in the middle again. Nothing abnormal about how many price reductions there are. Right in the middle of everything. This would not indicate a market crashing at all. And then Realtor.com also has lots of good stats down here on different regions, what the prices are doing, active listing counts for different regions, and then metro areas too. So you can see, right, some areas do have slightly decreasing prices, like Atlanta, Austin, minus 7%. Went up the fastest, they dropped down the fastest too. But most areas are seeing increases. Columbus, up 13%. That's crazy. Hartford, up 17%. Houston, down a little bit. Jacksonville, down a little bit. Indianapolis, up. So some markets will go up and some will go down. That's how it's always been. There's usually hardly ever a solid trend in every area in the country. Even during the crazy crash we had in 2008, there were some markets that did okay and didn't have a huge crash. I believe Washington, D.C. was really stable, almost had no drop at all, where other areas had massive drops. So that's what is happening with the market. Now, what about inflation and interest rates? Okay, so first I want to show you, a lot of people post this number. I just went to Google and typed in mortgage rates. You might not be able to see that behind my face, but I promise I did. And you'll come up with this 30-year fix, 7.5%. It's like, what? That's crazy. Well, first off, you might remember I did a video. I wrote an article on my blog, investformore.com, about how they changed the fees and rates for different types of mortgages. A lot of uproar about that, and it did change the rates and fees for how much down payment you put down. It's crazy. It makes no sense, but this will show you what I was saying is actually true. This is for a 20% down payment. The rate is 7.524%. If you make this a 5% down payment, you're putting less money down, the rate drops a full 0.1%, because the new system does reward people for less money down. How that makes sense, I can't tell you, but that's what the government has decided to do as far as what they're charging in fees for different loans. And yes, it is now lower to have a 3% down payment as well as a 5% or 20% down payment. Crazy. But this also tells you there's a huge difference between a 700 credit score and a 780. If we put this at 780, now we're down below 7%. If we put it at 800, it doesn't drop. Okay, that makes more. Oh, it did? Nope, didn't drop. Okay. And the state might change differently a little bit. The loan amount could change a little bit, but I just don't like to use Google. I don't think they're that accurate, and like these numbers really change the numbers a lot more than I think they should. So what you can do is go to some other sites like Freddie Mac, which we can click on here and just search for mortgage rates, and Freddie Mac will tell us, there you go. Their average, what they're seeing is 6.7%, 6% for a 15-year firm. And that is also what I hear lenders say too. A lot of Google rates are way higher than what lenders are quoting when I see it in real life as well. And then you can see their chart historically, what it's done. It went up to over 7 for a while there. In October, went back down below 5, according to some people. Maybe not them. Then it went back up again. Now it's right about 6.7. Now, if you look at 5-year, you can see it's down to 2-3%, crazy low rates. And it shot up, and people think, oh my God, the world is ending. Look how high rates are. But honestly, if we go back all the way to 1974, rates started in the 7s, went up to 18% in the 80s for a short time, and were all much higher than they are now. Honestly, all the way up until the real estate crash. Maybe a little bit lower here. They were in the 5s, but 6, 7 was not unheard of in the early 2000s when the real estate market was booming too. So yes, rates are way higher than they were a couple of years ago, but historically, they're not that high. I know people don't like to hear that. I personally don't like to hear it. I think low rates are much better for everybody. But the simple fact is we don't have crazy high rates. I think they're, higher than they should be, but it's not something where it's like we've never seen this before. Now, will rates go down? What will happen with them? Let's look at inflation. All right, so they just came out with inflation numbers today. I'm on tradingeconomics.com. I love this site because it shows us month over month inflation. Most people just talk about year over year. This is month over month. So in June, there was 1.2% inflation for that month. I don't know if you can see that, but you'll have to believe me. In July, there was 0. And you can see since June, inflation has been relatively low. And every month we go, inflation is going to drop significantly because these really high inflation months are dropping off on the year over year numbers. So if we make this a 5-year chart, you can kind of see we're pretty much back to normal. This is 2019. You can see we had a negative inflation during COVID. Again, COVID did some really weird things, all the stats. We jumped up, you can see up and down, and then we started to see higher inflation, dropped a bit, then real high inflation along here, peaked right here in June of 2022, and then it dropped back down. And since June of 2022, you can see it's right in line with normal, maybe slightly higher than normal, but it's nothing crazy. Even if we go back 10 years, look at this. Does this look similar to all of this? Maybe a tiny bit higher, but for the most part, inflation is pretty similar to what it has been before COVID. And I know a lot of people actually, don't like it when I say inflation is down because they say, oh my God, my bread's more expensive, my eggs are more expensive, everything is more expensive. And yes, it is. I'm not saying that you don't know what you're talking about or that stuff isn't more expensive. What I'm saying is most of that stuff got more expensive last year and the year before that. And yes, you're still feeling it. Yes, it sucks. I'm not saying inflation didn't happen, but the rate of increase right now has decreased to really close to normal or what it was before COVID. Stuff is still going up, but it's not going up as fast. And the reason why that's important is because if stuff is going up at a slow level, slow pace, theoretically the feds should not raise rates anymore, and they should not make mortgage rates higher, which makes car payments higher, it makes house payments higher, it makes investment loans higher, it makes loans that companies get to construct new businesses, to construct new facilities, to increase supply, to build houses. Almost every company uses debt or they buy supplies from a company that uses debt. If interest rates are high, their costs go up. If their costs go up, the cost of their goods to consumers goes up for them to stay in business. So I know a lot of people say interest rates have to go up to stop inflation. I don't think that. I've gone over this before. I think that's actually backwards thinking. But whatever it may be, inflation is pretty much close to normal, which means rates hopefully should stop going up. We'll know tomorrow. Not saying it that will happen because the Fed doesn't always do, I think, what they think they should do. But we'll see what happens. And if they stop raising rates or maybe even lower rates a little bit, that means mortgage rates could go down. Then we'll see what happens with the housing market. But it should, even if the housing market booms again, that will mean there's more building. That will mean car payments are lower. Places can build more facilities, have more supply, and hopefully costs could even stable out even more with lower rates. We'll see what happens, but that's a possibility. I don't want to get ahead of myself because I've been saying this for months and months and months that inflation is down, which you can see here, and the Fed keeps raising rates. So we'll see what happens. All right, that is what is happening in the housing market right now. Let me know what you think. It is not crashing. It probably won't crash. Commercial real estate, there's some questions about it crashing or having issues because a lot of those loans will reset at higher rates and people might not be able to get those loans. Could be an issue. They also said the same thing might happen in 2012. It didn't. So you never know for sure what's going to happen. And if rates do stabilize, if they start to go down some, that could help fix that problem as well. So we'll see what happens there. All right, leave a like, leave a comments, leave a shares. Let me know what you think. I'll be back with more videos, especially on my properties here, coming up soon.